hot topic webinar. Are value stocks better than growth title, let's say? In this context, I just want to give a short introduction here to what we will look at in the upcoming 45 minutes around. So first of all, we want to give an introduction to what are growth stocks, what are value stocks, and especially, and this is probably also very interesting when looking at today's Fed decision in the evening. You probably depends a little on where you are located in the world, but in our case, German time, it's 8 p.m. Central European summertime, says. Yes. So that being said, the Fed tonight will give some insights into the upcoming monetary policy, and then what she plans to do in the upcoming months, in fact. And given the recent numbers around inflation, numbers have pointed to rising inflation, and not just rising inflation, but in addition to that, also rising concerns whether the Fed now has to taper, whether she has to hike yields. And quelle surprise. I mean, that's usually an environment which is not that promising for growth stocks, as you probably have heard and learned over the last weeks and months in our hot topic webinars here. And so that brings us to the third question of today's webinar. So why value could outperform or respectively could continue to outperform growth? Because after the massive run growth title have seen over the last 12 months around, from the end of the corona pandemic, or end of the corona pandemic in terms of the end of the volatility it caused in financial markets, and the massive monetary stimulus which was delivered, not just monetary but also fiscal stimulus from the US government in this case. So growth has seen a tremendous rise. You probably have all witnessed the massive push higher in Tesla shares, for example. And since the beginning of this year, and since yields started to climb higher, probably anticipating higher inflation, we have seen a continuous, let's call it, rotation from growth back into value. And especially now the question arises, will this rotation come to an end rather sooner or later, or will it probably continue? And this is exactly what we want to have a look at here in the upcoming minutes then. Beside of that, if you watch this now on YouTube, please leave a thumb up here. Please leave a comment in the chat box below. Please ask all your questions. And by the way, I love the Street Fighter thumbnail too on YouTube. So it's Vincenzo posting here in the Zoom webinar. But coming back, please leave a thumb up here if you enjoy the webinar. If you have any questions, feel free to ask them on YouTube. I have the tab open here, so I can answer your questions in real time. If you have any questions watching the recording now, post them in the description box below. Share the video. Yeah, that's it around it. So now let's have a look at the screen. Before we start and we go through here in this context the agenda once again, respectively, all the topics I just mentioned in further depth, I'd like to point out once again the rebranding currently taking place at Admirals, at Admiral Markets, now becoming Admirals. So what's behind this step, the rebranding taking place, that has something to do with the aspect that Admiral Markets started in the FX and CFD universe around I'm quite sure it was 20 years ago. They started with a very, very successful journey back then. I'm currently offering over 8,000 financial instruments, having offices around the globe, and all this here highly regulated by the FCA, by the ASIC, by the SISAC, by all the other big regulators around the globe. And so now the thing is that they decided to expand their offering, in fact, to other financial services and products like a credit card, for example. But in addition to that, there will also be, or there's some plans around crypto, the crypto space here in this context. And all this being said, now points to the rebranding process currently taking place. So the offering stays the same. It's expanded, in fact, but it's not Admiral Markets anymore, but now it's Admirals. And you can find the website on admirals.com. You also can check out admiralmarkets.com and will be redirected to Admirals, just that you're not surprised. Also very active on social media channels. Here's for example, the Instagram channel here, where you can follow Admirals under @Admirals Global. And so now that's it around the introduction. Now let's have a look here at the agenda today, but not look too much on this agenda, but now fill this with more input, in fact, and start right away with answering the question here on what is growth, what are growth stocks, so that we are on the same page and that we know what we're all talking about here. So growth stocks or usually we call a company a growth company if the company is expected to grow sales and earnings at a faster rate than the market average. So this is usually a growth company. And there have been several growth titles over the last months which made headlines, especially Tesla, but also its direct Chinese competitor. We talked in depth about NIO, for example. We also talked about Roku at one point. We talked about Zoom. We talked about the ARK Innovation ETF from Cathie Wood, which is investing actively in this growth space. All this being said here, brings us to a very important point. When we look at these growth titles, usually we look at them and consider them to be really expensive. And these stocks, growth stocks, usually trade at high, very high price earnings ratio. So price earnings ratio is short here in PE ratio. The thing is that such valuations could actually be cheap if the company continues to grow rapidly, which will drive the share prices up. And rather sooner or later, there will be kind of a transition then from a growth to a value company. This is something which is currently taking place, for example, when you look at Amazon. So Amazon, no one would consider Amazon to be a growth company, classic growth company, but Amazon has been a growth company some years ago and now established its name in the space and is currently can be considered in fact more a value company. Same is true for Apple, by the way. So and now coming back to the PE ratios, I mean, look at the PE ratio from Tesla, for example, which is not even sure. Is it still 1,000 to 1? I'm not sure, but there has been a time at least when it was 1,000 to 1. A current company which traded at oh my gosh, let me just think about this. After the split last year in August was 5 to 1. Currently, the stock is trading at $600 per share. So this is 3,000. And even before that, there was a split. So it was tremendous high PE ratio, and it's still very, very high. Many market participants, especially those looking at growth companies from a classic fundamental view, or look at it from a classic economic perspective based on classic economic numbers or company numbers in this context you learn in university, for example, once you study kind of business administration, master of business administration, for example, look at it from a CFA perspective, chartered financial analyst. The thing is that even if it's to some extent true that it needs to be seen whether this company can continue to grow at this fast pace, it still doesn't make any sense to, for example, say this will likely result in a crash. I mean, the thing is that these companies usually tend to be, how can we say, they have a high beta, we call this. What do I mean with high beta? This is the next point here. So what investors do when buying a growth stock is they're paying a high price for this growth stock based on the expectation that the growth will continue and these expectations will be realized. If they aren't realized, then growth stocks can see dramatic declines. This is one of the main reasons why we refer to these stocks as high beta stocks. And this is, by the way, also one of the reasons why you can sometimes see stocks from, well, the ones like, I mean, Tesla, for example, or let's take another name. What do we have? Zoom, Roku, whoever. And especially last year, once you've seen this tremendous rise higher, the question arose, how can it be that a stock is losing money? So earnings per share, for example, is negative. That means that you lose money per share in this context, but still see a positive reaction to such a print, such a at first glance negative earnings release. The reason for that is because they up their forward guidance. Sometimes they up the full year guidance. This is something in short we refer to as FY, and then you see usually FY20 or FY21. It's the full year guidance. And if they up their guidance, and it's not just up, but it's upped above the expectations from analysts, well, this is usually a very confidence, a sign of confidence and a sign of continued growth. And this is usually something which is considered from market participants, especially from so-called Momo hedge funds, for example, hedge funds who are looking to trade momentum. Which is usually considered very positive. And this is then one of the reasons why the stock continues to rise, because market participants are here paying the premium, the high price for the stock. At first glance, they consider the price to be high. They pay a higher price in expectation that the growth story will continue. And still, if these guidances then are taken down, and this is also something we've seen over the past months, in fact, so then numbers come in, the company brings in positive numbers, earnings per share is positive. So whatever it might be comes in above expectation, but still they downgrade their full year guidance because they say, well, we're not really sure whether we can continue this at this pace to grow our company. This is usually something which is then resulting in market participants taking cash off the table, saying, okay, well, then I don't want to have the stock anymore because I'm betting here on growth story. And if this growth story does not continue, well, then I sell the stock. And this is usually something which is then resulting in sometimes very volatile and very sharp rises and declines, especially when it comes to earnings reports in this context. And what usually happens is that these growth stocks, and this brings us, in fact, directly to the hot topic today with the Fed announcement in the evening, even though we won't dig too deep into this. But overall, the question is around, and these are not really rumors, but it's potentially what market participants are currently focused on. What we right now expect, in fact, is that the Fed will probably start to taper and reduce the overall liquidity, which finds itself in the market after this massive liquidity access happening post the COVID-19 pandemic to fight the economic downturn, which resulted naturally out of the pandemic hitting and the lockdown hitting and all this, so on and so forth. The thing now is that it makes, at first glance, it makes sense that there will be kind of reduction when it comes to the liquidity being provided. That's especially true when looking, for example, at reverse repos, which have hit something like 0.5 trillion USD, I think, recently. So there's massive liquidity, liquidity in the market, cheap liquidity. Cheap liquidity is usually something which is driving, especially growth stocks higher, since here in this context, especially a company which is only looking at higher growth rates, and in addition to that, not paying something which we will look at in the upcoming slides when it comes to value stocks, paying a dividend. So a company like, I'm very sure, in fact, that Amazon is still not paying a dividend at all. Nvidia is paying a dividend, but it's a very small dividend, even though I wouldn't really necessarily consider Nvidia a growth stock. But in general, Tesla, for example, right now, it's a classic growth stock, is not paying a dividend. So there's no real cash flow. The only income source, well, if we can call it only income source, but are capital gains and are the growth rate at which the company continues to grow and the stock moves higher. And which is something which is especially attractive if this is the only income source, in fact, you can find in the market. What do I mean by that? Well, if liquidity is not just cheap, but if you put your money in a bank account here, getting zero interest rate per year or 0.1% or something like that, Well, this is very unattractive. And what will you do? I want to see my money grow. So you will buy stocks, and especially will you buy stocks who have a high growth outlook, in fact. And so growth stocks are the natural place to go if dividends are low, respectively, if you have a low yield environment. So let's come back to the Fed once again, probably in the evening. So which directly bringing us to what can we expect, in fact, if the Fed today announces some kind of taper, which she will naturally not do. I mean, it's not possible to taper in the current environment. If the Fed announces to some extent any taper, markets will crash. That's just what will happen, and especially growth will sell off sharply. The same is also true for gold, but there will be, as a natural consequence, there will be stronger demand here for gold then, given the current inflation expectation picking up. So all in all, this is what will naturally happen in such a scenario. Let's come back now to the aspect. What's the Fed currently looking at? It's not that she tries to keep prices stable or keep price stability, but it's more like she wants to make sure that the employment situation continues to look prosperous, let's say, in the upcoming months, years from now on, given the developments around the corona pandemic. Well, if you now crash the equity markets, which is naturally something the Fed has not yet or has never intended to do, in fact, well, what's then happening here is that it's also giving some difficulties for the overall growth outlook for growth companies who continue to invest. If money flows into these companies and they invest in new technology, well, they create a positive employment situation outlook, for example. So the Fed, in fact, has no real choice to taper and to reduce the liquidity, which is currently flowing in the system, and continue to pump more liquidity into the system. The only question now arises is what of this liquidity, or much of the outlook here, is already priced in, because now if inflation, for example, picks up as it does, and yesterday, for example, we have also seen producer prices picking up. This is the next aspect which you look at when looking at a growth company here. If you have margins now decreasing, so which means like if consumer prices see a pump or push on the upside, and producer prices stay the same, usually that means the company which is producing XYZ makes more money. Once producer prices rise, and this is something we've seen and witnessed in several markets in the commodity space, soft commodities, but also especially hard commodities. If you look at lumber prices, for example, and the recent vertical move higher, that's a perfect example in this context. So the thing is that here inflation picks up, and now producer prices also pick up, which means that reduces the overall margins for companies, and here in this context could also weigh on the margins and thus on the growth outlook for these growth companies, which means even if the Fed continues to pump more liquidity into the system, does not necessarily mean that growth stocks continue to perform well. And this is something which we should keep in mind here in this context now when we look at the comparison here of growth to value titles, and why value could probably outperform growth now. So here, the last two bullet points. So what I already told you is growth stocks typically don't pay dividends, and classic growth stocks are Tesla, Roku, or Zoom. We can also look at the ARK Innovation ETF on the website from Katie Wood, for example, and get a full list here of the recent investments in their ARK, ARKK, and you have a full list of something like 20, 25, 30 high growth names right now, which are currently hot in the current environment. So what we have here is now a chart which is showing you in orange, it's the ARK Innovation ETF. And you can see here in turquoise, this is square. You can see here in yellow, I'm sorry, this is not true. Here, this one here in orange is Tesla. I'm sorry. Here you can see the chart. This is here the chart from the ARK Innovation ETF, which was, by the way, trading at, I'm not really sure where was it trading when I took this screenshot, but it traded significantly lower. Let me just check here. Oh no, it's the same level. It's 113. So meanwhile, it dropped slightly, but as of now, it's trading within this range, around 110, 115. Let me just check. ARK is, what do you have it here? 150 right now. So that was the closing price yesterday. So yeah, this is ARK here, the candles, and then it's overlaid with Tesla. In orange, in turquoise, you have Square, and in yellow, you have Roku. You can see all these three are positively correlated with each other, so which is understandable given all the components I brought into play over the last several minutes here. And so now let's have a look here at value stocks. What are classic value stocks, or what is this? So a value stock is trading at levels that are perceived to be below its fundamentals. In this context, I'd recommend remembering or rewatching our webinar we had several months ago on Warren Buffett here, who is a classic value investor. And we looked at his investment style in an earlier webinar. Let me just see if I can, if I click link, copy the link, and now let me share this here in the chat box. Where's the chat box? I lost the chat box. 1 second. Okay, that's not, oh, there's the chat. Okay, that's easy. So I call this Buffett and share it here in the Zoom event, but also on YouTube. 1 sec. Let me just share it here. Oh, and I don't really know whether I'm allowed to do that. Is it possible to share it on YouTube? I'm not sure whether there's probably some kind of filter. So if it's not, Katie, probably you can repost it then in the chat box on YouTube. If not, well, you can also check the search function and Buffett Admirals, and then usually you should be ready to go to find the webinar. But before you watch this video, please stay here. There will be plenty of charts and some very interesting developments, in fact, which we can or will discuss. So, classic value investing, Warren Buffett. This is the key name here in this context. And what are the common characteristics of value stocks and value stock investing? Well, first of all, value stocks usually include high dividend yields. They have usually a low PB ratio and a low PE ratio. Here in this context, further details, we don't dig too deep into this now, but further details here can also be found on the website from Admirals. By the way, let me just also here share this in the chat box. So I shorten it up and I call it AM website for Admiral's website. And there we have it. So there is also a blog article, especially on value investing and what this is. It's also here. It's like, there we go. And these are common characteristics, especially the PE ratio component is very interesting because if you look at it from a classic perspective and growth, especially in such an environment in which we currently find ourselves, companies going vertical, or, yeah, well, this is difficult to say. If you look, for example, at the stock price from Twitter or something like that, but the first question which came to my mind right at around 10 years ago was like, where do these companies make money? I mean, how is it possible that a company like Google is making money? Well, today we know that. Because they are selling lots of data here in this context. So it's not for free. If you have a Google Mail account, for example, it's not that they offer this for free, but you are the product. You don't have to pay for this because you are the product, and so you can easily use their services, and they take you as their product, and then they data mine you if you want. So Google definitely knows more about you than your wife or your husband in this context, certainly. The same is true when we look at companies like Facebook, when we look at companies like Twitter, for example. All this is very important to understand, but difficult to grasp. And so, especially for growth companies, this is a very important component, and the growth outlook outlook here in this context, and the fantasy behind this, and then the imagination plays a very, very important role. For someone who's a classic value investor, these valuations sometimes do not make sense, and thus, especially companies which are stocks which are considered value stocks, are usually companies or stocks here which have low PE ratios, and thus such sometimes, let's call it, absurd developments, as in the Tesla shares, for example, well, certainly are something to be kind of difficult. Remember the Snow IPO? That was in, I'm not really sure, it was in October, September, October, something like that, last year, 2020. Snow is a cloud service company in this context, which is direct competitor probably to Amazon, companies like Amazon. And why was the Snow IPO so interesting? Well, classic growth company, growth stock, but a big investor right from the start was a guy whose name is Warren Buffett. And if a value guy like Warren Buffett starts to invest at least part of his portfolio, his money, in a company like Snow, in a cloud company or a cloud computing company in this context, growth name, well, then it's probably a value story. Not really sure about that. I haven't checked the chart from Snow, but this is something to keep in mind, why such an IPO becomes especially hot if such classic value guys like Warren Buffett start to look at companies in the growth sector. But let's come back to value stocks in general, an introduction here. So value stocks are usually something we refer to blue chip companies. This was also something we mentioned in an earlier webinar, hot topic, or was it trading spotlight? I'm not really sure. But all in all, it's a blue chip company we usually look at. It's an established company. It's a stable company. It's well recognized corporation. So it has a brand in the market. So 3M, Alphabet / Google. Funny, because I just referred to Google as a growth company. That's years ago, so that has dramatically changed. The same is true for companies like Amazon, also former a growth company, now an established name. Everyone knows Amazon. American Express, also credit card company, and this is a financial service provider. Apple, also former growth company, now an established name. Bank of America, classic banking sector, financial industry. Coca-Cola, certainly. And these are companies we usually refer to as so-called value stocks. And blue chip stocks are seen as what we could or would refer to as relatively safer investments or safe investments with a proven track record of success and stable growth, and companies which are in the market for sometimes 100 years, probably even more than that. So in Germany, for example, a classic value company or value stock, which comes directly to my mind all the time once I think about trading or once I think about value stocks in general, even though I have never ever traded the company, is Siemens, for example. So and they have overcome certain, let's say, drawdown periods, and probably, for example, First World War, Second World War, Great Depression, 1920s, the Cold War. We had the terrorist attacks in 2001, for example. So over and over, Corona pandemic, still there, the company, it's stable, it's established, and it has seen lots of headlines over the years, but still the company is there. And this is something which is true for value stocks in general. One thing I already mentioned is that value stocks are usually high dividend or high dividend yield companies or investments in this context. But these are not necessarily or absolutely necessary. So for a stock to consider a value stock, even though that many probably we can say of these blue chip companies and value stocks here have long records of paying stable, respectively rising dividends, so-called dividend aristocrats. In this context, for example, Target is also a company in the US which recently hiked their dividends for, I don't know, the 50th time in a row or something like that. So also a classic so-called dividend aristocrat. But let's come back here to value stocks now in the real world. And I have here a look at the chart. So what do we have? We have here Apple. So this is the Apple chart. By the way, you can see here, this is a chart from TradingView. I took this because here you have also the splits included. So the last split which happened here, that was in 2020 in September, August. It's not the first split. In fact, if you started to invest something like 20 years ago, you've probably seen several splits, not just one, but several. So this is the Apple chart, and then I compared Apple here to other companies. For example, Amazon, so highly positively correlated, as you can see, but not as positively correlated as growth stocks are correlated to each other. We have here in what is this in turquoise? This is it's 3M. Yeah, it's 3M in this context, and we have KO here in yellow. This is Coca-Cola. So you can see all of these companies have certainly witnessed or have seen here a sharper decline once the Corona pandemic hit. Even though also no big surprise, who will profit the most from this environment, or will be one of the biggest profiteers here in this context? Certainly Amazon. So what I remember really well was there was a decline due to deleveraging, market participants reducing their overall stake in Amazon shares, for example, and there was this massive deleveraging, and then Amazon took and was off the races. The same was true for Apple. Two established names already, still with some growth component to be included. Amazon probably to be considered one of the sole competitor in the e-commerce business, at least in the Western world. So what we can certainly see is there was stable performance from there, but you can also see a well-diversified value portfolio is not as concentrated as when it comes to growth stocks. So this is not 100% true, but it's still definitely to consider, especially when looking at an ETF like the ARK Innovation ETF here, and so much hot money flowing into this ETF. As of now, it seems as if the fund stabilizes again, but the question arises: what happens if the tide turns? What happens if we see massive outflows from growth companies here? Then I could imagine, especially the ARK Innovation ETF from Katie Wood, to see some serious headwinds. We have already seen what could happen. That was in early March. Yes, early March. So this is definitely something to consider. In case of a value portfolio, it's not that we do not see any drawdowns, but longer term, it's a well-diversified value portfolio is probably not the worst choice. So now, still, this is long term. The question is, when does the tide turn? So this is what now the topic of today's webinar here we'll look at. And what we have here is two charts I overlaid. It's value, which is right now outperforming growth. So just let me explain what this illustrates here. So the chart you can see here, the candles are where this is the iShares Trust S&P 500 Value ETF. The ticker symbol is IVV. Okay, and then we have in an orange here, you can also see this massive outperformance. This is in fact the IVW. It's the same iShares Trust, but it's looking at growth companies solely. And what you can see here is there was a massive outperformance in growth, especially in the first 3 months after the Corona pandemic hit. So there was this massive drop lower, and then we not just regained all these losses within, let's say, 2-3 months. It was more like 2 months, but here till September we marked new highs, and not just that, but we saw a heavier bounce here, a pull in that was early September, and then stabilized. And especially after the presidential election in the US, growth took off once again. So there's still an outperformance which could be measured, no question about that. But what you can also see is, and we're looking here at this blue vertical line you can see in a chart. This is the 4th of January 2021. That was the first day of trading in 2021. And from there, if you here carefully watch, you can see that especially this decline, which happened here in March and April, was completely absorbed from value, but in fact, what you could see is that we saw stable positive performance in value here of this period. And we continue to mark new highs and continue to mark new highs while volatility increases. So it's not that value growth is not performing well anymore. And again, it could continue continue to perform well, but, and this is the thing, it's not a given. First of all, it's not a given that the Fed will continue to flood markets with liquidity, which is usually resulting in an overall positive environment for growth stocks. But in addition to that, inflation pressure is definitely something we should keep in mind, and which could weigh heavier on growth stocks, given the reduction in margins here overall, and thus an environment in which then growth stocks will likely face some serious headwinds, and where value could really outperform growth. And by the way, it's not just that we have now seen value outperforming growth into the year as of now, the first 6 months, but we outperformed, but there is significant more room given the performance which we have seen here in the last 10 years, in fact. And there's also something we will look at here in the next slide. First of all, still, I want to point out here my thoughts in a more detailed way, respectively in a more structured way, and answer the question why value could really outperform growth here, and respectively continue to outperform growth in this context. So first of all, we have in the growth environment a very crowded trade. So one second, please. So given the massive run into growth stocks in 2020, especially post-COVID, so from early April onwards. So Tesla, Roku, also the ARK ETF, Innovation ETF, which has a high exposure in Tesla stock, for example. And US yields continue to rise, which is very interesting. So usually, again, you don't expect yields to rise in an environment where cheap liquidity is provided. So once yields start to rise, there are not that many explanations why this is happening. Probably it's a combination of both. But first of all, I think the rise in yields, in US yields here, is mainly due to the fact that market participants start to anticipate higher inflation ahead. It's not because they think that the overall US economy continues to boom as it did over the last 10 years. So first of all, this is most likely the main reason in this context. And in addition to that, it's also true that if the US economy was that strong, would it be really necessary to pump in 1 trillion Corona relief package after the next into the market, cut taxes, and continue to support the economy as the right now Biden administration, but also earlier the Trump administration did? Is it really that necessary? Wouldn't it be kind of in Germany we call this Selbstläufer. This is like you don't need to give that kind of support, but it just moves because it's strong. So put it that way. So you don't need to push and push and push and push, but it's more like it runs and it continues to run. There's momentum and we continue to run. Right now, it seems like if there is no that continuous support from the US government and this monetary support from the Fed, well, then the machine would rather sooner than later just die. Let's put it that way. And the machine would start to stand still, in fact. And so that being said, is something to keep in mind, which is pointing again into the direction of inflation picking up due to the massive monetary stimulus support here. And still, nevertheless, so all in all, at the beginning, it was an environment in which growth performed extraordinarily well once again and accelerated, let's put it that way, given the developments in the last decade, in fact. But probably many growth stocks have probably got ahead of themselves, potentially underperforming now in the months to come. That doesn't mean that they're not performing well anymore, but that they probably won't continue to outperform. while value title, on the other hand, here usually tend to perform well, especially when we are now headed into a stagflationary environment. So in an environment in which we see economic, not a downturn, but at least a top out in economic activity, probably a downturn. And in addition to that, inflation picking up. So this is usually an environment in which especially precious metals tend to perform very well, gold especially, but also value titles tend to outperform growth title in this context. So this is something to keep in mind, and why this recent trend, which we now see taking place over the last 6 months since the beginning of the year, could really continue. In addition to that, there's also this technological revolution. So you probably have heard the saying, technology is eating the world right now. And this is bringing us directly back to this first thought here in this crowded trade. So where everyone is somehow positioned in. And so why this might be true in the long run, that technology continues to eat the world, and probably Tesla will outperform everyone, and there will be the day once we will fly to Mars, and the only cars which we will see there will be Teslas. But given the dampened economic outlook in the near term, which will likely weigh on growth, and not just the dampened economic outlook, but in addition to that, picking inflation picking up, we come back to the same idea. So probably tech title / growth title got ahead of themselves, and in this context, it's in my personal opinion, not unlikely that we will probably see at least a stabilization of the current market capitalization of these growth title at an elevated level. Still, probably there won't be kind of a sharp downturn due to the expected support, especially from the government, U.S. government in this context, and probably we'll see kind of a long-term consolidation at an elevated level, similar to Netflix, and then we will see this massive breakout on the upside, or similar also to Tesla. Once again, another breakout. But all in all, again, it's more likely that this vertical move on the upside won't necessarily continue as we've seen it over the last years. While, for example, if you look, for example, at mining stocks, it's also potential value title, in fact, like Barrick Gold, really underperformed over the last months due to also the corrective move we have seen in gold, for example. So you've probably seen that the gold sector performed extraordinarily well. That was shortly after the corona pandemic, with all this massive monetary stimulus from the Fed being delivered, gold pushing to new all-time highs, yields pushing lower, real yields dropping, and thus gold shot off the roof, or shot through the roof in this context, while also Barrick Gold pushed to an above 30 USD per share, only to see then in the especially fourth quarter, if I'm not mistaken, to see a decline of something like $10. So I think earlier this year we traded around $20 or something. Now, yeah, not really taking on very much strong momentum again, but it seems like the stock probably has bottomed out. And that being said, brings us to the point that probably now it's the time for value stocks from this perspective, so that these stocks are now continuously will outperform growth. In addition to that, now we come to another, I think, quite interesting aspect when we look here at a growth title. So the lesser and lesser migration between value and growth. What do I mean by that? Well, migration usually refers to companies being reclassified to value or growth, depending on their current situation. So in this context, we remember what I was talking about in terms of Apple, Amazon. And when looking, for example, at Amazon, one might argue that the monopolistic position of Amazon prevents new companies from gaining market share, which is then bringing Amazon in a position of a value company, which prohibits any further growth taking place. In a rough sense, certainly, but just to understand that aspect. So they're the companies who establish themselves in the growth sector already. This is also, by the way, true for Tesla. Just remember, that was recently, if I'm not mistaken, when Elon Musk once said in an interview, was it a tweet? Was it? I'm not really sure. He said, well, he really looks forward when it comes to competition. And the reason is very simple, because Tesla is well established in the electric vehicle space. Just imagine now you're going out and say, hey, I want to buy a new car. And given the overall outlook for our society and having responsibility for children, I want to give my two boys here a good a clear sign, and I say I buy an electric vehicle. So probably now you say, well, I'm not really sure whether I want to buy a Tesla, but probably I buy, let's say, a BMW. I don't know. And so now you make an experience, and I'm not really sure whether this is really true, but just imagine it could happen. You're disappointed, kind of disappointed, because something's not working as it should. So where will you go? You say, well, electric vehicles, all in all, I like this idea. So I'll buy a new electric vehicle, but I don't stay with BMW because I'm disappointed for whatever reason, something not working. It's like the beta version is not as expected, whatever. So what will you do? Well, you look for the flagship in this area, right? So what will you go for? I'll go for Tesla. That's the name. That's the place to be. In China, probably it will be NIO. But all in all, even in China, Tesla has already a brand established. And that being said, brings us to this point, less migration between value and growth. So overall, these companies who are looking for growth need a favorable environment, which they do not find when inflation picks up. And once, rather sooner than later, the overall fiscal and monetary support from central banks, respectively the government here, disappears. And this is something to definitely keep in mind in this context here. So, and then we have now something very interesting from a statistical standpoint. Value is very cheap compared to growth. So between 2010 and 2020, value has underperformed growth annually by 6.11%. So you were better off investing in growth despite the massive volatility, higher volatility, and the growth name as respectively in high beta stocks in general. Still, over the last 100 years, so this let's call it fight between growth and value has gone on now for decades. It is that value beats growth by an annualized 3.19%. So that being said, brings us to a very important aspect. Over the last 10 years, there was a massive underperformance from value compared to growth, which probably is now bringing us to a point where we reach a potential extreme, let's say, and thus value has a high chance of outperforming growth then. In fact, the current period here of value underperformance compared to growth can be in fact considered the most extreme in terms of duration and magnitude. And if we get to see a mean reversion here, depends a little, but certainly the overall economic environment, global macroeconomic picture looks very similar, or looks favorable for value, at least put it that way, then we could see a significant shift back in favor of value. And this is definitely a scenario which seems likely possible, and which is already bringing us here to the summary of today's webinar. So first of all, let's look back at what is a growth company, what's a value company. So we call a company a growth company if the company is expected to grow sales and earnings at a faster rate than the market average. A value stock is trading at levels that are perceived to be below its fundamentals. Classic value investors are, for example, Warren Buffett. Between 2010 and 2020, value stocks have underperformed growth annually by 6.11%, but over the last 100 years, value beats growth by 3.19% annually. And it seems at least that we probably have seen the starting point of this mean reversion move here from value compared to growth. And the three potential reasons why value could outperform growth in the months, respectively, probably years ahead. Probably this is now the years of value in this context are, first of all, growth investing seems, especially after the last years here, potential crowded trade. There's less migration probably taking place between value and growth. Amazon as an example here in this context. And historically, value is cheap compared to growth and invites to a mean reversion trade risk reward wise, which means nothing more than now you would probably wonder, okay, what shall I do? Well, if you have currently a portfolio which is consisting mainly of growth title, and probably start to think about rotate a little into value, add a little value to it. I think this could, and a good mix here. It doesn't necessarily mean you need to be 100% in value now, but it's probably a good idea to rotate a little from growth into value, keep the most favorable names, especially those who probably you see now entering a phase, especially in growth sector, a phase of consolidation, which could take several years. And then similar to Netflix, probably over the next 5-6 years, however, whatever, then sees the breakout on the upside and continues its massive run higher once this rotation has ended or ends then in this context. But still, to reduce the overall volatility in your portfolio, some addition here of value stocks seems definitely to be a quite good choice. And that's it. So next webinar takes place on Friday together with Paul. Check out the website, admirals.com, and there the webinars tab here under education. So you can find it here, admirals.com, and there's an education tab on the right side of the page, and there you have the webinars tab. And there you can register for the upcoming webinar together with Paul. And I think he really looks forward to present his topic there to you. There are the contact details from Admirals for further information. global@admiralmarkets.com is, first of all, the email address. YouTube, you can also find now under Admirals Global, if I'm not mistaken, but also Admiral Markets. And highly regulated broker, very important in this context. So this is the rest disclaimer. I hope you enjoyed the webinar. If you enjoyed the webinar, if you watch this on YouTube, if you watched the recording, please leave a thumb up here. Add your comment in the chat box. Subscribe to the YouTube channel. I really look forward to the next webinar, which will take place together with me next week on Friday. And that's it from my end. So all the best. Happy trading. Watch your stops. See you.